So dear students, welcome back to the next session, that is 13th session. So this is the third session in the securities analysis. So first we have discussed about the introduction to securities analysis. In that we have the analysis of variable income securities. The second session was about fundamental analysis. In that we have discussed about economic analysis. So this is the next session where we are going to study about the industry analysis. The fundamental analysis is divided into three layers: economic, industry and company. So now we are going for the industry analysis. So we have fundamental analysis. In that we are going to discuss about the second layer, that is industry analysis. So what we studied in the previous class, it is about the economic analysis. So this chapter aims to provide an overview of security analysis, as I have told in the previous session itself. What are the session outcomes? So in this session we are going to study about how to carry out, or you will be able to understand how to carry out the industry analysis. Industry analysis. What is an industry? An industry is nothing but a group of homogeneous companies or group of firms producing reasonably similar products which serve the same needs of people or common needs of the buyers. That is what is an industry. So here it tells an industry is a group of firms that have similar technological structure of production and produce similar products. Industry analysis is nothing but an evaluation of the relative strengths and weaknesses of particular industry. So as I told you in the first session of this chapter, industry is nothing but a group of companies. So for example, if I talk about textile industry, there are various groups of textile industry. If I talk about automobile industry, we have various groups of automobile industry. If you go for electronics, we have LG, Samsung, Sony, Whirlpool, so many companies are there in that particular industry. So here that analysis, what we are going to do about that particular industry is called as industry analysis. So generally now electronic products have a boom, automobile industry have a boom, every individual wants to have a bike, every individual wants to have a four-wheeler, and now every middle class person, earlier it was a luxury product, now sometimes it has become a necessity of life. So depends on the need and depends on the demand for the product. So that has to be analyzed. So what we do here is we do market assessment, and of course industry analysis itself is a market assessment tool designed to provide a business with an idea of the complexity of a particular industry. So here we try to find out the complexity of a particular industry, and based on that the investor can make an investment decision. So the next one is objectives of industry analysis. Here we go for industry analysis to understand how industry structure drive competition, which determines the level of industry profitability. So what is the competition the industry is facing and what is the rate of profitability, and to what extent the industry is attractive. As I told, the trend is now now mobile industry has become so famous because of the demand for that, and any brand comes in the market, of course it is surviving because the demand is more. So hence as of now we say that that is one of the attractive industry. Software companies, of course, they are also doing good. So it depends on the prosperity of that particular industry. Next one is to use evidence on changes in industry structure to forecast future profitability and improve industry profitability. So we want to improve the industrial profitability, and what are the key success factors for that particular industry in the economy, that has to be studied. That is the reason why we go for industrial analysis. The next one is to do industrial analysis. We have a model that is called as Porter's 5 Force model, and it is a business strategy developed by a person called as Michael E. Porter. It determines the competitive intensity, ultimate profit potential of the industry, and captures the key elements of the industry competition. The 5 factors are: the first one, potential for new competitors to enter the industry. So here we have to understand what is the potential for the new competitors to enter the industry. Is there a threat, or there is an easy way to enter into the industry? So here what happens when the new competitors come into the market, there are so many problems which they can face. So sometimes there will be so many obstacles from the existing industries in the existing companies in the industry. So what happens, they avoid the new entry. So that is one factor what they have to consider. The next one is efforts of existing competitors to improve market share. So here existing competitors generally try to increase the market share, that is they want to capture the market by increasing their sales. When there is slow growth in the industries, what happens, the existing market players in the market try to capture market and try to dominate in the market. So that has to be considered by the investor. Next is pressure from competitive products from other industries. So what happens, sometimes there are certain products which can be considered as substitutes, and such products will limit the return that the industry can make on its products. So here for example, we have a fiber glass insulation competing with styrofoam insulation. So here the business within an industry may have to collaborate in promoting their industry's products. So if they want to compete against alternative product, sometimes they may have to go for collaboration and they have to survive in the market. And many times we have pressure from the customers. So a customer will not be willing to have same kind of product. Always customers are subject to change. They will be having more expectations from the product, and sometimes they may not cope up with the costs and they try to switch for the other products. So what happens, there will be a threat to the industry because of the customers. The next one is there will be some pressure from the suppliers also. So why sometimes suppliers exert pressure on the industry in setting product prices? So there are numerous reasons why this may occur. That is, sometimes supplier has a few dominant participants who control the prices. So at that time what happens, the manufacturer has to purchase from the same supplier at the price whatever it is being given by the supplier. So all these factors will have an impact on the industry. So if all these things are favorable, you can go for that particular industry security and invest in that. The next one is components of industry analysis. Here we have various components which should be considered for analyzing the industry. The first one is competitive structure. As we have discussed in the Porter's model, there is lot of competition by the various companies in the market. Here it is given in a different form. So in order to survive, the industry has to be competitive. So basically, which company the industry is in, what are their market shares, what are their which companies in the industry are publicly traded, and whether there is an increase in the number of competitors or the company is having a domination in the industry. That has to be understood. The next one is permanence. So what is the extent of permanency? So what is the extent of the industry being not changing? So it is nothing but the sustainability duration of the industry in the competitive market environment. So it has to answer the following questions, like, is the industry likely to survive in the long run? Will that industry survive in the long run? Are there any technological threats to the industry, or are there any government threats, regulatory threats from the government? That has to be understood by the investor. The next one is the phase of life cycle. Generally, as a product has a life cycle, industry also has a life cycle. Whether the industry is, which stage of life cycle the industry is in, and the best returns and most risk involved in that particular cycle in which the industry is, and every industry will have different phases like birth phase, growth phase, maturity phase, stabilization or decline phase. You might have studied the product life cycle. Same way industry also will have a life cycle. So which stage the company's industry is in, that is also very important. The next one is vulnerability of the external shocks. This refers to the extent of exposure of the company to external factors or external forces and how the company is being affected by the external forces. Is there a chance for the industry to be nationalized by foreign governments, or are they dependent on suppliers for key commodities, or is there any external political pressure, or this industry exposed to any fashion trends? So when these things are there are more chances of the industry being not surviving for a long run, and there's an industry being facing a lot of competition. That has to be understood by the investor. The next one is regulatory and tax conditions. Generally what happens, there are certain industries which may have to undergo tax pressure and there will be a lot of problems for that. What are the current regulations of the industry? Are there any likely new regulations to be formed for that particular industry? Are there any special taxes for that? For example, on alcohol we have a lot of taxes, on tobacco we have a lot of taxes. So once we have more taxes on oil companies, all these factors has to be considered and investor has to take into consideration. The next one is the labor conditions. What is the condition of the labor? What is the percentage of unionization in that particular industry? Or this unions hostile? Whether the unionization is increasing or decrease? And what are the, is it easy for the industry to get the qualified labor whenever it is required, or there is any problem for the industry? For example, high-tech industries cannot get the qualified labor. So that is an condition which has to be considered by the investor. And generally this all these things will be done by the experts, and there will be some analysts to do this, and so they will take care of all these factors because they are experts in that particular field. And historical financial performance. Here we try to find out the past performance and the present performance of the organization. That is the record of the industry, revenues, earnings and dividends paid by that. And we also take into consideration the financial variables, cyclical variables and counter cyclical variables. And whether the company is been slowing rapidly or slowly or on an average, all these will be considered. A company which has an average growth is preferably good. And what is the cost structure of the industry, whether there is heavy fixed cost or there is more variable cost, all these things will be analyzed by in the industry analysis. The next one is financial and financing issues. So here, what is the debt, leverage, we call it as debt and equity in the organization, and what is the ratio of the current and fixed assets, and whether there is this industry is labor intensive or capital intensive, and what are the average age of the fixed asset, how much investment is done in fixed asset, how much is done in debt, equity, all that will be analyzed by the investor. And generally here we also consider industry stock price valuation. So what is the overall industry price? So we try to calculate the price earning ratio. What is the level of price earning ratio, whether it will have an impact on the economic condition, and what is the relation between the economic condition and the price earning ratio of the economy. All these things will be considered in the industry stock price valuation. So we have a separate topic for stock price valuation, so we will discuss that, students. Hope you have understood this. The next one is we have classification of industries. Here the industries are classified according to reaction to the different phases of the business cycle. One is growth industry, cyclical, defensive and declining industry. So growth industries are expected to grow persistently and its growth is likely to exceed the average growth of the economy. Cyclical are those who move closely with the rate of industrial growth of the economy and fluctuate cyclically as the economy fluctuates. During the boom period they enjoy growth, during depression they suffer a setback. So it goes like that. Defensive industries It includes firms which move steadily with the economy and decline less than the average decline of the economy in a cyclical turn down. So they will have less impact. For example, food and shelter are basic requirements of humanity. So the food industry will withstand a recession and depression. They will not die at any cost. The next one is declining industry. These are industries which generally decline absolutely or grow less than the average growth of the economy. The next one is multiple choice questions we have, students. So if an investor searches for patterns in security returns by examining various techniques applied to a set of data, this is known as fundamental technical data mining random walk theory. It is technical analysis. The last step in fundamental analysis is economic, industry, company, technical. It is actually company. We have 3 layers in that. Which of the following are shown on the balance sheet on a cost or market value? Cash, stakeholders, equity, marketable security, fixed assets. It is marketable security. Which of the following terms best describe the shareholders' equity item of the balance sheet? Book value, market value, current value, stock value. It is market value. Which of the following sections of a balance sheet are inventories listed? Current assets, property, plant, equipment, current liabilities, shareholders. So inventories come under current assets. So the following are the references what we have, students. You can just go through that. I'll see you in the next session. Thank you.